In the 1990s, gold was untouchable, the one thing the world still believed in.
The stock market is now down 21%.
It couldn't default. It couldn't disappear. It couldn't lie. Or so everyone thought. Behind locked vaults and polished bars, a quiet illusion was spreading. Billions of dollars in gold that didn't exist. Papers forged, shipments faked, entire deals built on bars filled not with gold, but with tungsten and lies. From secret offices in Asia to boardrooms in Europe, the illusion grew. Banks, traders, even governments all played their part, never realizing the metal they trusted was nothing more than paper promises. For years, no one asked questions. No one checked the vaults until one day, someone did. And what they found shattered the illusion of safety forever. Because this wasn't just a scam, it was a warning, a reminder that even the oldest symbol of trust can be corrupted when belief replaces truth. This is where the story begins. In the 1990s, gold was believed to be the safest asset on Earth. It didn't default, it didn't vanish, it didn't lie. Or so the world thought. Behind the polished vaults, the glittering bars, and the reputation of global bullion banks, something far more dangerous was unfolding. A deception so vast that it ensnared major financial institutions and even governments themselves. Traders were moving billions of dollars worth of gold that in many cases didn't exist. Documents were forged, shipments declared that never left any port. Entire deals were built on bars filled not with gold, but with tungsten, brass, and lies. This wasn't the work of a few clever criminals. It was a system, one born out of secrecy, greed, and the blind faith of a market that trusted paper more than metal. By the time it was exposed, some of the biggest names in global finance had been fooled. The scandal became known as the Great Bullion Scam of the 1990s, a fraud that began quietly in Asia, spread through the world's largest banks, and nearly shattered the foundation of confidence that held the global gold market together. And yet, outside the world of finance, few remember it today. This is the story of how fake gold flooded the real world, a story of illusion, power, and the dangerous belief that even gold, humanity's oldest symbol of trust, could not be corrupted. To understand how it began, we need to return to the late 1980s. The Cold War was ending, global trade was booming, banks were expanding faster than ever before, chasing new markets and higher profits. And at the heart of this fast-changing world stood gold, not as a currency anymore, but as a pillar of stability. Even though most nations had left the gold standard decades earlier, gold still played one vital role. It was trust itself. Central banks stored it. Bullion banks traded it. Investors hoarded it. The London Bullion Market Association, the LBMA, became the center of this network, setting global standards. Gold flowed through London, Zurich, Hong Kong, and Dubai in massive quantities. But by the 1990s, most of that gold no longer moved as metal. It moved on paper. For every physical bar sitting in a vault, there were often dozens of paper claims to it, contracts, loans, and leases, all tied to the same gold. The system worked as long as everyone trusted that the gold was really there, and that trust would soon be tested in ways the world had never seen. The scam began in Asia, the beating heart of the world's gold demand. During the late 1980s, countries like India, Thailand, Singapore, and Indonesia were consuming gold at record levels. Jewelry, bullion bars, and investment-grade gold became symbols of prosperity and stability. But heavy taxes, strict import laws, and currency controls created a perfect storm, a thriving black market where smugglers, refiners, and brokers blurred the line between legitimate trade and organized crime. In that shadowy space, a few opportunists made a discovery that would change everything. They realized that in an industry built entirely on trust, it was far easier to fake documentation than to move real metal. Certificates, export forms, delivery receipts, all could be forged with a few stamps, seals, and signatures. You didn't need to steal gold. You could simply pretend it existed. It started small. A handful of exporters in Asia began producing forged shipping documents that claimed gold shipments were leaving for foreign buyers. Those papers were sent to banks overseas, which accepted them as collateral for loans or as proof of trade. Paper backed by paper. The forgeries were so flawless that even seasoned bullion traders couldn't tell the difference. Soon, the scam grew. Networks of refiners, brokers, and even corrupt customs officials joined in. Fake shipments increased in scale and complexity, and the money, first millions, then billions, began flowing through the system. By the early 1990s, the Great Bullion Scam had evolved into a full-fledged international operation. At its center were a few key figures in Southeast Asia. Businessmen who claimed to represent large, reputable gold refiners. They approached major global banks with trade documents that appeared completely legitimate, bills of lading, assay certificates, and insurance guarantees, all showing shipments of high-grade bullion from Asia to Europe. But in reality, no such shipments existed. The gold was fiction, a product of ink, not metal. Still, because the papers bore the right stamps and signatures, banks believed them. Some of the world's most trusted institutions, including the Union Bank of Switzerland, Standard Chartered, and even the Reserve Bank of India, became indirectly involved. Loans were issued, payments cleared, money moved. And yet, the gold itself was nowhere to be found. By 1991, the scam had reached its height. Dozens of supposed gold consignments were listed as traveling between Singapore, Hong Kong, and London. Behind the scenes, a handful of fraudsters were constructing intricate documentation chains, layer upon layer of false proofs that fooled customs officials, insurers, and auditors alike. Every shipment appeared real, every form checked out. Until, one day, someone decided to look closer. In 1992, an anomaly caught the attention of investigators in India. Several banks had issued enormous loans based on gold imports that somehow had never arrived. At first, excuses flowed easily: shipping delays, customs errors, bureaucratic slowdowns. But as weeks turned into months, the pattern became undeniable. Every missing shipment traced back to the same few exporters. When Indian authorities finally launched a full investigation, what they uncovered was staggering. The gold shipments hadn't merely gone missing, they had never existed. The documents were forgeries, stitched together using serial numbers from old, legitimate shipments. Insurance papers were fake, certificates carried the names of real refineries that had no idea their identities were being used. For years, the scam had operated right under the noses of the world's largest financial institutions. By the time the truth came out, losses exceeded $2 billion, a colossal figure for the 1990s. Even worse, much of the fraud had slipped through the safeguards of respected bullion banks that prided themselves on their precision and due diligence. The flaw wasn't in the math, it was in the trust. If a shipment was insured, stamped, and logged, it was assumed to be real. Few people ever saw the actual gold. The entire market had begun to believe in paperwork more than the metal itself. When the story broke in 1992 and 1993, shockwaves tore through the global bullion industry. Newspapers in Asia and Europe called it one of the largest financial frauds in history. Banks scrambled to explain how so many fake trades had passed their checks. Investigations spread from India to Singapore, Hong Kong, and Switzerland. The Union Bank of Switzerland, one of the world's most powerful financial institutions, became the first major casualty, forced to write off massive losses from false trades. Soon others followed: Standard Chartered, Credit Lyonnais, and even the State Bank of India. Executives were questioned, auditors were deployed. Governments quietly pressured bullion markets to tighten their verification systems. But the damage was done. Confidence in the gold trade, a market built entirely on trust, began to fracture. Insurance companies imposed stricter rules. Customs authorities started double-checking every shipment leaving Asia. And for the first time, the financial world began to grasp just how fragile its foundation truly was. Billions of dollars had moved through invisible gold, and no one had noticed until it was far too late. In the aftermath, regulators around the world scrambled to rebuild trust. Shipping documents were standardized, gold bars were assigned improved serial tracking, and customs procedures became stricter and more transparent. For a while, it seemed the system had learned its lesson. But as history would show, the fixes only went so far. By the late 1990s and early 2000s, a new illusion began to take shape, not through forged shipments this time, but through paper gold trading, leasing, and a practice known as rehypothecation. Bullion banks discovered they could sell the same gold dozens of times over without ever moving it. Paper contracts replaced physical supply. Once again, belief replaced verification. The illusion had simply evolved. The same weakness that allowed fake bars to circulate now allowed massive leverage to build within financial markets, invisible, complex, and far more dangerous. Gold still symbolized safety, but beneath that gleam lay the same old fault lines. Today, most gold trading depends on derivatives and unallocated accounts. Investors rarely own actual bars, only promises of ownership, shared among hundreds of others. According to the LBMA, the volume of gold traded daily in London exceeds the total physical supply stored there. Some estimates suggest there may be 100 claims for every real bar. If too many investors demanded delivery at once, the system could strain, just as it did in the 1990s. Even central banks aren't immune. In 2013, when Germany requested to repatriate part of its gold from the United States, it was told the process would take 7 years. 7 years to retrieve metal that was supposedly already theirs. The parallels are haunting. The great bullion scam exposed a truth the world preferred to forget: that trust, when left unverified, isn't stability, it's faith. And faith can be broken. The gold market once believed that paperwork equaled reality, that a signature guaranteed truth. But all it took was one scam to reveal that even gold, the oldest symbol of wealth and honesty, could be corrupted by assumption. Every financial system creates its own illusion. In the 1990s, it was forged shipments. Today, it's digital contracts and invisible gold. The illusion changes shape, but never disappears. Crises don't start with explosions. They begin quietly in the spaces no one checks. The Great Bullion Scam wasn't just a story of fraud. It was a story about human nature, about greed, blind faith, and the fragility of trust. Because in the end, the only difference between wealth and a lie is whether anyone bothers to check the vault.